Copper is the tell in the global economy again. In the last few sessions, prices whipped higher, then snapped back, not because electrification vanished, but because the market is colliding with a simple reality: there isn't much slack. When copper moves like this, it's rarely just a commodity story. It's credit, China, grid build-out, and supply chain all at once. Traders track inventories, mine disruptions, and smelter behavior, while manufacturers quietly lock in supply. The question isn't whether copper matters, it's who gets priced out first when demand rebounds and supply can't. Here's the plain English setup. Copper demand is being pulled in two directions. The long-term pull is electrification. Power grids, EVs, data centers, and renewables need massive wiring. The short-term push comes from restocking, and any hint construction and manufacturing are stabilizing. Supply can't respond quickly. Grades decline, water constraints bite, permitting takes years, and disruptions are routine. Smelters and refiners can tighten things further by shifting output or bidding harder for concentrate. Combine tight buffers with headline-driven sentiment, and you get sharp jumps on small news. Copper is acting less like a boring metal and more like a macro trigger. Copper often front-runs economic turns, earning the nickname Dr. Copper. Big rallies have tended to align with synchronized global growth or infrastructure waves, while sharp drawdowns show up when credit tightens or building slows. Over the last 2 decades, China's urbanization turned copper from an input into a strategic commodity. Then the renewable boom added structural demand: wind, solar, EV charging, and transmission. Supply got tougher too. The easy deposits were mined first, pushing new projects into higher altitudes, harder jurisdictions, and more complex ore. That history matters because even normal demand can now strain the system. Markets are reacting in 3 places: futures, physical premiums, and inventories. Futures swing as traders reprice growth expectations, rate cuts, and supply tightness. In the physical market, premiums for deliverable metal can spike when manufacturers worry about getting material on time, not just at the right price. Inventories are the third signal. When exchange stocks fall toward historically low levels, the market becomes hypersensitive to outages, shipping delays, or sudden buying. Watch spreads too. Nearby contracts can trade above longer-dated ones when availability is tight. That structure signals the market is paying for metal now, not promises later. The ripple effects run far beyond miners. For producers, higher prices can expand margins, but only if costs don't surge and operations stay stable. Jurisdiction, labor, and energy matter. For manufacturers, copper is a direct input. Cable, appliances, autos, and electrical equipment feel it immediately. Utilities and grid contractors face higher project costs, delaying upgrades or forcing renegotiations. Investors get exposure through mining equities, royalty firms, physical-backed products, and commodity indexes. Even tech and AI infrastructure is copper-heavy because data centers and transmission upgrades require tons of metal. Copper exporters can see currency and fiscal shifts when prices swing. This is a value chain story. Geopolitics and macro are the accelerants. A weaker dollar or rising rate cut odds can lift commodities, and copper often responds fast. China is the major variable. Property stabilization, stimulus, or credit easing can boost demand, while a slowdown can cap rallies. On the supply side, key producing regions face political and environmental pressure. Permitting delays, royalty disputes, and water constraints can stall mines for years. Shipping routes and energy markets matter too. Smelters are energy-intensive, and fuel or power disruptions reduce refined output. Meanwhile, US and Europe industrial policy is pushing grid resilience and domestic manufacturing, quietly adding copper demand through the cycle. Smart money watches copper like a dashboard, not a single gauge. Macro funds and CTAs trade it as a proxy for global growth, rotating exposure as rates, PMI data, and China signals shift. Physical merchants focus on spreads, warehouse flows, and premiums, hunting tightness they can monetize with storage and logistics. Mining investors evaluate project pipelines, capex discipline, and jurisdiction risk, favoring scalable production and manageable costs. Hedges matter too. Fabricators may lock forward prices during pullbacks, while miners sell future production to fund expansion. Retail often arrives late, but disciplined buyers scale in via diversified miners, partial sizing, and clear risk limits instead of all-in bets. The bear case is simple and dangerous to ignore. Demand can disappoint if manufacturing rolls over, construction stays weak, or China stimulus underwhelms, pulling prices down fast. Supply can also surprise. A major mine returns, new projects ramp smoothly, or smelter output rises and loosens balances. Financial conditions matter. A stronger dollar, higher real yields, or risk-off shocks can force liquidation across commodities. Substitution and thrifting are real. Aluminum can replace copper in some uses, and manufacturers redesign to use less. Finally, speculative positioning can amplify downside when crowded longs unwind. Copper can be structurally bullish and still deliver brutal drawdowns. Retail investors don't need to day trade Dr. Copper to respond well. First, decide what you're buying: a short-term macro trade or a long-term electrification thesis. For long-term exposure, consider diversified miners or baskets over single-asset bets because operational risk is real. Use pullbacks to scale in, not headlines to FOMO. Watch 3 weekly indicators: exchange inventories, nearby versus far spreads, and China credit or infrastructure signals. If you use ETFs, know whether they hold futures or equities and what that means for roll costs and correlation. For mining stocks, track costs, jurisdiction risk, and capex. Predefine exits. Copper is volatile, and survival beats prediction. The outlook is a tug-of-war between cyclical growth and structural scarcity. Near-term, copper will trade headlines: rates, the dollar, China policy, and supply disruptions. But zoom out. Electrification isn't optional. Grids are aging, renewables are expanding, and AI-era power demand is climbing. Weakness can be opportunity, but only if you respect timing, volatility, and project risk. Treat copper as a strategic commodity with macro sensitivity, not a one-way bet. Over the next year, watch inventories and treatment charges for early signals of tightening or easing. If spreads flip tight again, availability is the story, not sentiment.